In this video, we're going to show you everything you need to know about trading Forex fast. Forex affects every aspect of your daily life, from buying your morning coffee, to refueling your car, to going on holiday. This is all made possible through the process of Forex in motion. There is also a free Forex Trading Beginner's Guide that works in combination with this lesson. We'll show you how you can get it later in this video. So what is Forex exactly? The word Forex is a mashup of foreign exchange and is commonly used to refer to the foreign exchange market, the largest financial market in the world. Picture a massive marketplace trading across all the corners of the globe. But rather than having goods on sale, this market trades in global currencies. The Forex market, or foreign exchange market, is one of the most widely traded markets in the world, with daily trading volume of over $6 trillion. Unlike the stock market, the Forex market is open 24 hours a day, from 5 p.m. Sunday to 5 p.m. Friday, Eastern Time. So you might be wondering, where exactly is the Forex market based? Well, it's actually everywhere. Forex is a decentralized market with no single central authority or exchange that governs it all. Instead, it is made up of a network of banks, brokers, dealers, and even governments who trade currency with each other. Also, make sure to hit the like button, as it allows for our team to continue to produce more free content on YouTube. Let's now go through some of the key concepts you must know. Currency abbreviations. Each currency is represented by a 3-letter code called an ISO code. Here are some of the main currencies traded. USD is the US dollar, also known as simply the dollar. AUD is the Australian dollar, also known as the Aussie. NZD is the New Zealand dollar, also known as the Kiwi. EUR is the euro. CAD is the Canadian dollar, also known as the CAD. GBP is the British pound, also known as simply the pound. JPY is the Japanese yen, also known as simply the yen. CHF is the Swiss franc, also known as simply the Swiss. What is a currency pair? In Forex, currencies are traded in pairs, because when you trade Forex, you are buying one currency while selling another at the same time. Let's look at the pound-dollar currency pair, for example. The first currency in a pair is the base currency, and the second currency is the quote currency. Let's say you get a quote of pound-dollar as 1.2655. This means for every 1 pound, you get 1.2655 of US dollars. There is always an invisible one beside the base currency on the left. So here's what happens when you actually trade currency pairs. When you buy a currency pair like the pound dollar, or when you go long on the pound dollar, you're expecting the pound to appreciate while the dollar depreciates. When you sell a currency pair like the pound dollar, or when you go short on the pound dollar, you're expecting the pound to depreciate while the dollar appreciates. Major currency pairs. These are the major currency pairs, which all include the US dollar, as the US is the world's largest economy. Starting out, we recommend sticking to trading major currency pairs, as they are the most liquid, meaning you can get in and out of positions easily and fast, and with tighter bid-ask spreads. What is a pip? In the land of Forex, exchange rate changes are measured in pips. A pip stands for a percentage in point, or a price interest point. This is a standardized measurement for the smallest whole unit price move that an exchange rate can make. If the Australian dollar is sitting at 0.6751 and its value gained by 1 pip, it would move to 0.6752. Most currencies are written to the 4th decimal place, with the 4th decimal place representing 1 pip. However, some exceptions buck this trend, such as with the yen-crossed pairs. The Japanese yen is often quoted to 2 decimal places. So a 1 pip gain would be 146.22, rising to 146.23. There's also a pipette, which is a fractional pip that is 1/10 of a pip and is represented by the 5th decimal place. Before we continue, we want to hear from you. Tell us in the comments below right now what video topics we should cover next. As always, please hit the like button, as it allows for our team to continue to produce more free videos on YouTube. Lot sizes. In Forex, positions are usually measured in lot sizes. A standard lot represents 100,000 units of the base currency. A mini lot is a tenth the size of a standard lot and represents 10,000 units of the base currency. A micro lot is 1,000 units of the base currency. And a nano lot is 100 units of the base currency. Bid, ask, and spread. Each transaction has a bid and an ask price. These two prices form the basis for trading on the Forex market. When you're looking to buy an asset on the Forex market, you will pay the ask price for the base currency. When you're looking to sell an asset on the Forex market, you will sell at the bid price. The difference between the bid and ask price is called the spread. In essence, the bid-ask spread is the difference between the price a dealer will buy a currency and what they will sell it for. The spread covers the dealer's profit and the cost of the transaction. It is essentially the cost you pay to enter the market. It's important to note that different brokers can offer different spreads, or they may offer variable spreads that can change based on market conditions. Brokers and leverage. You, as an individual retail trader, require a broker to access and trade the Forex market. Brokers provide leverage, which is you using borrowed capital from the broker to trade much larger positions than you otherwise could with the amount of money in your account. Imagine leverage like using a financial lever. With a lever and minimum strength, you can lift heavy loads with less effort. Like a lever that magnifies physical strength, financial leverage magnifies your trading power. Essentially, leverage turns up the volume on trades. However, with the potential for more profit comes the potential for more loss. It's important to keep in mind that leverage can act as a double-edged sword. Leverage offerings vary from broker to broker and are usually expressed in a ratio, such as 1 to 50, 1 to 100, or 1 to 500. Usually, traders will be required to deposit a margin of the trade to act as collateral for the leveraged position. Liquidity. Visualize a vast global marketplace where many players are trading. Each transaction barely makes a ripple on the surface, like dropping a tiny pebble into the ocean. Because of the market's vast size, people can quickly enter in and out of trades without causing much disruption to the exchange rate. Simply put, a liquid market is a financial market where lots of trades occur, and it's easy for traders to buy and sell. Market volatility. High volatility means prices are changing rapidly and by significant amounts, like a crazy roller coaster ride with sudden drops and steep climbs. Notice the drastic and wide swings of price, which signals high volatility and means that there is more risk for your trades, but also more reward. In times of low volatility, the market is calm, with smaller exchange rate fluctuations and price changes. Low market volatility is like leisurely riding on a scenic railway. Notice the small swings of price, which signals low volatility and means that there is less risk for your trade, but also less reward. Now, there are many factors that can cause market volatility to increase or decrease. Things like inflation, market demand, foreign policy announcements, political and economic conditions, economic data releases, central bank decisions, natural disasters or crisis, changes in interest rates. With all these factors at play that cause swings in price, speculating on exchange rate fluctuations is one of the most common ways for individuals to make money trading in the Forex market. So how do people make sense of the Forex market? Well, traders can employ a range of trading strategies, one of which is technical analysis. With technical analysis, traders study historical price movements and data in order to identify similar patterns that have the possibility of repeating themselves in the future. The idea here is history loves to repeat itself. Think of technical analysis like a detective hunting down clues to uncover how an individual acted in the past in order to try and predict how they will act again in a similar way in the future. Here are a few simple examples of technical analysis in action. You look at historical price movement and notice price was making higher highs and higher lows, signaling a moving uptrend. So you believe in the future, price will continue to make higher highs and higher lows. So you want to look for long trades to trade with the moving uptrend. You look at historical price movement and noticed that price was making lower highs and lower lows, signaling a moving downtrend. So you believe in the future, price will continue to make lower highs and lower lows. So you want to look for short trades to trade with the moving downtrend. You look at historical price movement and notice every time price came to this area, it reversed drastically, which means this area is of high interest to buyers and sellers. So you believe in the future, if price comes back to this area, there is a higher percentage chance that price will reverse off of it again, which presents trade opportunities. You look at historical price movement and notice that every time price touched this trend line, it bounced off of it. So you believe in the future, if price comes back to this trend line, it'll bounce off of it again, which presents trade opportunities. Now, another method people use to trade the Forex market is fundamental analysis. Fundamental analysis examines the broader macroeconomic and geopolitical factors that influence the exchange rate and currency value. Picture fundamental analysis like compiling a weather forecast. As a forecaster, you are analyzing the atmospheric conditions to create a prediction for future weather events. Rather than atmospheric conditions, Forex traders are looking at factors like a country's economic indicators, such as GDP growth, inflation, and unemployment to gauge the health of the country's economy, interest rates and monetary value, political events and government policy change, central bank statements, any breaking news and/or significant market events. They use this information to try and predict the upcoming market fluctuations in exchange rates and currency value and use them to their advantage. Many traders use an economic calendar as a way to keep track of upcoming economic events or announcements. Now, as promised, to access the Forex Trading Beginner's Guide that works in combination with this video, go to the description below and click the link for instant access. Make sure to hit the like button, as it allows for our team to continue to produce more free content on YouTube. Also, tell us in the comments below right now what video topics we should cover next.